Matt, good to see you. A really important topic today, the ACA cliff, the $1 income mistake that could cost you thousands in health insurance. One of the biggest surprises people face when retiring early has nothing to do with investments. It's about healthcare. And starting this year, a little known rule under the ACA is creating a really shocking outcome. Earning just one extra dollar of income could cost you thousands in additional premium costs. Can you explain what changed, please?
Yes, Aaron. So back during COVID, Congress passed an extension of the tax credit or the tax credits for premium that allowed people that made higher income to qualify for tax credit. And this is way back in 1920, and they were basically they ran out, if you will, in 2025. So people enrolling for 2026 plan logged in to find out that they're paying substantially more for their healthcare than they were the last, even 10 years. So if we look at the chart here, the orange is the 2026 tax credit. Basically, your two-person household tax credits based on your household size, and that's how you file your taxes. So if you have tax-dependent kids, they're going to count. But 82,000. So you make 84,000. You make 82,100. You no longer have that tax credit. This chart is showing your cost, not the tax credit. So you went from paying $600 to $1,600, close to $1,800 in 1 year. So, we've been in the exchange since 2014, the first year of the exchange. We were there. I've been doing healthcare since 1999. And really, we do it for a lot of our retiree clients.
Mm-hmm.
And
Right.
it's been such a, just say a challenge for everybody across the board.
Of
So,
course.
but
Absolutely.
that's where we're at.
Yes. Well, and I know that you also focus on people who want to retire early. So, what does this mean for those people who need healthcare before they're eligible for Medicare, which starts at 65?
You definitely have to plan it ahead of time. Don't be one of these people that just retires and says, I'll figure out healthcare later, because you could go from, paying zero on your employer plan to 20 grand a year for you and a spouse. And I'll tell you right now, Aaron, just because you're paying 20 grand a year doesn't mean you get the Lexus of a plan. I mean, it's not going to be the quality of a plan that you had before. You're going to have higher out of pocket, most likely, higher deductible. But the other thing is there's no plan in our state and in many states. That's what we would call the PPO. By that, I just mean you get that big book of doctors. You can go anywhere you want to go.
Mm-hmm.
When I say
Mm-hmm.
anywhere, a lot of them have 90% of the doctors in network. The point being, the individual plans in the exchange, if you go out of your state, a lot of times you don't have coverage.
Mm-hmm.
So that's how it is here in Washington, unless it's ER. So it's a whole different world. You got to plan ahead of time, because you could have a lot more out of pocket, not just on your premium, but on the care.
Right. And who gets hit the hardest?
Middle class, and really those who do not have a plan. Those that just wake up when, you need to plan this out. You definitely do. And specifically regarding your taxable income. The tax credit is all based on your adjusted gross income. So there's a lot of things that we can do to help prepare you ahead of time, with that in mind.
So, Matt, let's say that I walk into your office today and say that I want to retire at 55. What can I do now then to avoid this income trap?
We want to make sure that you have a good amount of two things. One is tax-free income. Tax-free income, that's going to be your Roth bucket. In addition to that, we want to make sure you have a good amount of money in your, non-qualified accounts or your brokerage account, the bank, basically, because those two, the Roth is obviously tax-free, and on the non-qualified money, you're only taxed on the gain. And depending on, as long as we wait 12 months, this could be long-term capital gains at 15%. Mm-hmm. So we definitely want to make sure you have the right buckets filled, so that we can bridge your income until we get to Social Security at age 65 off of other sources of lower taxable income.
Mm-hmm. And one of those strategies you mentioned offline was the Roth conversion.
Exactly. We want to do the Roth conversions ahead of time. We don't want to make the mistake of doing it all in 1 year. And there's a whole nother can of worms to think about too there, Aaron, not just the healthcare, between now and 65, but we want to make sure we don't do too big of a conversion 2 years before Medicare, because then, as you know, we're going to have IRMA penalties. So there's a lot to this that can affect you financially in a substantial way. Again, not just with the premium cost, but with the cost of care when you use it.
Mm-hmm. So many moving parts. So just to kind of underscore for everyone, this really does come down to proactive planning. Income isn't just about taxes anymore. This is also going to directly affect your healthcare costs as well.
That it will, that it does. And it's the biggest expense for most people in retirement.
Mm-hmm. So much to consider. And again, Matt, as evident in having this chat with you, you've been doing this for a really long time. So if somebody wants to figure out how they can retire early and have a plan for healthcare, what's the best way to reach you?
Give us a call at 425-256-3105 or send me an email at mberkland@choosevault.com.
Great. Again, Matt, thank you so much for your time today. I really appreciate it.
Thank you, Erin.